Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Monash. On today's show, we're talking about the merits of two different approaches for raising capital. It's a bit like asking which is better, ketchup or mustard. Some people like ketchup, some like mustard, and some like both. The two funding models are the blind fund and the syndication for each project. Some syndicators have a preference for raising capital for each new project. Each project stands on its own, and investors who qualify to invest in these exempt market offerings make the decision to invest in each offering independently. They diversify their investments by investing in multiple different projects. Each project sits in its own separate entity, and there's no chance of a problem in one property cascading and affecting another property. There's a veritable firewall between each property. This structure is ideal for many investors since it allows investors to make individual choices on which project they want to invest in. The good news is that each project gets raised independently, and each project delivers its own results. The alternate approach is the blind fund model. As opposed to syndicating individual deals, a fund spans multiple deals. The fund model requires a stream of similar investment over a period of time that matches the life of the fund. The benefit of the fund is that you raise the money into the fund at the beginning, and once you have access to the funds, you can execute quickly on deals. You don't have to worry about being too aggressive when placing an offer. You know that you're going to be able to close since you already have all the funds you need to get the deal done. In today's environment, if you're going to be in the market for distressed deals when they become available, you'll want to have all the cash on hand before you even place the offer. There's going to be a lot of competition for the best deals, and they'll go to the ones with the strongest track record for closing. If you're going to raise a fund, your investors are going to want to see a track record, and some investors will not invest in a company's first fund. It's not hard to see the paradox that this logic creates. The idea of a fund makes a lot of sense. You might wonder, why would anyone ever syndicate individual deals? Well, when you have a fund, there's an expectation the fund will be generating returns for investors. Between the date the fund closes and the money being put to work, the investment capital is sitting in the fund manager's bank account earning zero. All the while, the investors expect a rate of return on their money. It's in fact possible to raise too much money into a fund, because if you can't put the money to work right away, you might feel artificial pressure to accept a deal that doesn't meet your standards because that deal maybe delivers 2% less than your target, but still better than earning zero, which is what it's doing when the money's sitting in the bank account. In a fund, you're restricted to a stream of investment deals that meet similar criteria. They might be all multifamily apartment complexes, say in Arizona, or you might do a fund that specializes in mobile home parks. You could have a fund that invests in assisted living projects or hotels. But if you're a new fund manager, how do you create a new fund with no track record? Well, you might go to your existing investors and offer to collapse some similar buildings from your portfolio into that first fund. This would shield existing investors from the ups and downs of a single property and offer a little bit of diversification. If you can get your existing investors to agree, the existing projects can form the seed of your first fund with a proven track record with which to overcome the first fund no track record objection. The fund manager model also offers the possibility of lower sponsor fees compared with single projects. The fund manager has the opportunity to spread the costs of the investment management infrastructure over a larger number of projects. Now, in our business, we actually have both. We've raised a fund, and we also have raised capital for individual projects. Both have got merits. But you have to remember that a single project creates an aura of exclusivity, whereas a fund suggests that it's open to all comers who qualify for the investment. It comes down to knowing your investors. The investor who invests in a single project may not be the same investor who would invest in a fund. Funds tend to be a little bit more opaque than single projects. Some hands-on investors will want the higher degree of transparency and reporting that's associated with a single project. As we're out hunting for deals in this post-COVID-19 environment, the blind fund model definitely has merits that are worth examining. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.